Hey everyone, this is Christo, and if you're having problems with options and you're struggling to understand options and losing money with options, then this video is for you. I suggest you click that follow button right now for more videos like this. So I'd like to go over a trade that Larry of Power Cycle Trading and Head Trader put on the other day. This is a trade for ExxonMobil. And you can see here I am using Thinkorswim platform, Charles Schwab, and I'm using the daily chart. Very nice bullish trend. Looks like it's trying to go to that 120, 121 level. So we're going to put on a diagonal. So I'll show you how to do that. So we're going to go to the trade tab here. And let's see, we're going to do the August 2nd calls. So if you're not familiar with options, we have our calls. When you buy calls, it's a bullish trade, and we have our puts over here. When you buy a put, it's a bearish trade. So this is a bullish trade. We're going to look at the August 2nd expiration, and we're going to look at the 118 call, which is right here. So you can see that they are trading around $2.60. So when we buy the call, we're going to click on the ask price, right? Up here, we have the bid and the ask. When we're buying, we're going to buy from the ask, we're going to buy from the sellers. So all I need to do is click here. Excuse me, get rid of that. I need to click there. And you can see that we have that price at $2.59. Options are always times $100, or excuse me, times 100. So the price is $259. So I want you to think about this. When we buy, somebody is selling to us. So as I mentioned, buying a call is bullish. We anticipate that the stock will increase in value. Therefore, the call will increase from 256, hopefully higher. But there's somebody taking the other side of the trade. That's the seller. If we're bullish, then the seller is bearish. The seller thinks that the stock price will be below 118 by expiration. And in return, the seller collects our money, our 253, let's say. The seller keeps our $253, and that's in their account. So I want you to keep that in mind for the next part of the trade. Before we do that, so we have everything set here. We have the August 2nd expiration, 118 strike, and it's roughly $252. So if you right click here, you can go to Analyze. And I want you to see something right here. This is the theta. I want you to remember the T as time decay. This means that if the stock is not moving much or just kind of chopping around, this determines how much the option is going to lose in value. So we see here that the time decay is 7.93. So $7.93. Let's call it $8. So if the stock just chops around and doesn't do much, you're going to lose $8 a day. That will increase day after day. And that doesn't include if the price of the stock drops in value. So I'm going to show you how to change that. So we're going to go back to the trade tab. And we're going to become a seller. We're going to be a buyer. We're a buyer of the call, and we're going to be a seller as well. So we're going to go to the July 26th right here, and we're going to sell the 121 strike. So 121s are right here, and they're roughly about 50 cents, or as I said, times 100, that's $50. So all you need to do is click on the bid side when you're selling a call. And we're going to collect, just like the previous example, the seller, we're going to collect this 50 cents or this $50 to reduce our risk. So I'm on a Mac. So what I need to do is hold down my control button, and because I'm adding a second leg, and I'll hold down control and click that. And then I get it. And you can see I reduced my cost already, about 50 cents. Before it was about $253. Now I reduced that cost to $2, which is $200. So you can see now I have the diagonal right here. And I have the August 2nd expiration for the long call, 118. I have the July 26th expiration for the short call for 121 totaling 203. So now look, let's look. I'm going to right click here. Let's analyze it. And actually I need to remove this part here and see our theta reduces drastically, almost to zero. So most of the time when you have the theta, it moves to positive. Let me see if I can get my drawing tool here. Most of the time it's a positive number. Maybe it's $9 or $10 or even higher. That means we're gaining money if the stock chops around. But right now we're at neutral. We're at basically zero if the stock chops around. So now we have our diagonal on. So let's see what options we have. If the stock drops in value, then just like anything, you're going to lose money. So we always try to keep our losses at 50 to 60% loss. If the stock drops to that, the option, the diagonal will lose its value to that amount, 50, 60%, and we're going to cut our losses and move on. Very, very important in trading risk management. Another option is if the stock stays in between, so we have our prices down here. If the stock stays in between 118 and 121, you can see here we're going to increase value. It's going to increase value, increase value, increase value. And then it kind of caps off here around 126. Ideally, another option would be if the stock stays below 121. That means, remember, the seller wants it to stay below. The buyer wants it to stay above. We were the seller on this 121 strike. So we want it ideally to stay below. And if that's the case, then that call option would reduce in value. I think we collected about 50 cents for it. It would reduce in value to 40 cents, to 30 cents, to 20 cents, to 10 cents, and let's say 5 cents or $5. We can buy it back and close out that portion of the trade, the 121 call. We collected 50 cents initially, $50. We buy it back cheaper for $5. That's a $45 difference. And then what we could do again, stay in the trade. We can go back, and that was the July 26th strike that we sold. We can go ahead and do it again and sell the 121 strike for August 2nd. And then we would collect roughly $1. So those are the ways you can reduce your risk by putting on diagonals, by selling the previous week, or the current week, July 26th. And then if you still want to stay in the trade, you can do it again and sell the August 2nd and collect more money. So I hope this helps you. Larry is having a webinar this Saturday at 11 a.m. Eastern, how to take advantage of earnings season. It is a must-see. He does this every weekend. So the link is in the description. Go ahead and click on that. And I want to hear from you in the comments below. Do you normally just buy calls, or do you sell calls like this as well, like such as diagonals or butterflies or long condors or even verticals? Please put that in the comments. So I hope you enjoyed this video. Once again, I am Christo. Happy trading.